At 9:59 a.m. on March 28, 2026, 1 minute before the Tel Aviv Stock Exchange opened for regular trading, the algorithms saw it, not the human traders, not the exchange surveillance system, not the Israel Securities Authority. The algorithms, automated trading systems at 17 different institutional desks across London, Zurich, Singapore, and New York, simultaneously detected an anomaly in the pre-market order flow for Israeli equities. An extraordinary concentration of short positions opened in the preceding 72 hours across 340 Israeli-listed securities, coordinated with put option purchases on the TA35 index totaling $2.3 billion in notional value. By the time the human compliance officers understood what the algorithms were flagging, the market had been open for 4 minutes. The TA35 was down 11%. By 10:30 a.m., it was down 28%. By 11:15 a.m., 41%. By 12:47 p.m., when the exchange's circuit breakers finally triggered a full trading halt, the TA35 had fallen 61.3%, $240 billion in market capitalization, erased in 2 hours and 47 minutes. Israel has been fighting a war on 4 fronts for 30 days. It has absorbed missile barrages, lost F-35s, watched its interceptor stockpiles deplete, and managed the psychological pressure of nightly sirens. Its economy has contracted. Its currency has depreciated. Its government has been running an emergency war budget. None of that, not the missiles, not the drones, not the cluster munitions, hit the Israeli economy as hard as what happened between 9:59 a.m. and 12:47 p.m. today, because this was not a market crash. This was a precision financial strike, executed from 14 jurisdictions, disguised as commercial trading activity, and designed to be impossible to reverse before the damage was done. To understand how this was engineered, you need to understand something that financial regulators have known for years but have never solved. Modern capital markets are simultaneously the most surveilled and the most exploitable systems ever created. They are surveilled because every transaction is recorded, time-stamped, and reported. They are exploitable because the same features that make them transparent also make them predictable. And because the global nature of capital markets means that a position built in Singapore cannot be stopped by a regulator in Tel Aviv until it is too late. Let me walk you through the operation. Because what happened to the Tel Aviv Stock Exchange today was not improvised. It was engineered over 18 months, executed through 14 jurisdictions, and structured so that by the time any single regulator understood what was happening, the position was already profitable and the damage was already done. The operation had 3 phases. Phase 1, position building. Beginning in September 2024, 18 months before execution, Iranian financial operatives began building short positions in Israeli equities through a network of shell companies, nominee accounts, and legitimate appearing investment funds registered in the British Virgin Islands, Cayman Islands, Cyprus, Malta, Luxembourg, Liechtenstein, and 8 other jurisdictions with limited beneficial ownership disclosure requirements. The positions were built slowly, deliberately, and in sizes calibrated to stay below the reporting thresholds that would trigger regulatory attention in any single jurisdiction. No individual account took a position large enough to require disclosure. No single broker handled enough volume to notice the pattern. Across the network of 340 separate legal entities, the aggregate short position in Israeli equities reached $4.7 billion in notional value by March 25, 2026. $4.7 billion. There's accumulated over 18 months. Invisible to any single regulator, Phase 2, the trigger. The operation was not designed to profit from a randomly timed market decline. It was designed to trigger one, and the trigger was not financial. It was informational. At 11:30 p.m. on March 27th, a coordinated release of fabricated intelligence documents began across 47 Telegram channels, 23 Twitter accounts, and 12 financial news aggregators simultaneously. The documents purported to be leaked Israeli Defense Ministry assessments showing that the IDF's Arrow interceptor stockpile had fallen below the minimum threshold required for continued operations. That Israel had fewer than 30 Arrow missiles remaining and could not sustain its air defense posture beyond 72 hours. The documents were fabricated. The intelligence was false, but by 3 a.m., The fabricated documents had been cited by 3 financial news services as leaked Israeli defense assessments. By 6 a.m., they were circulating in institutional trading desks across Asia and Europe. By 9 a.m., every major institutional investor with Israeli equity exposure was looking at the same question. If Israel's air defense collapse in 72 hours, what is the fair value of an Israeli technology company? The answer the market reached in the first 4 minutes of trading was 28% less than yesterday's close. Phase 3, the amplification. The short positions were structured not just to profit from a decline, but to accelerate it. As Israeli equities fell, the algorithmic trading systems that manage risk at major institutions began automatically reducing their Israeli exposure, not because of the fabricated intelligence, but because their risk models flagged the declining prices themselves as a signal to reduce exposure. The selling triggered more selling. Automated risk reduction triggered more automated risk reduction. This is what financial engineers call a cascade, and it is almost impossible to stop once it begins because every participant is responding rationally to the information available to them. While the aggregate effect of all those rational individual decisions is a collective disaster. By 11:15 a.m., the cascade had taken over from the original short position. The $4.7 billion in engineered short selling had triggered $180 billion in additional selling by institutional investors who had no connection to the operation and were simply managing their own risk. The weapon was $4.7 billion. The amplifier was the rational behavior of the entire market. If you understand why a financial operation is more precise than a missile, subscribe right now. Because what I am about to give you is the mathematics of what a 61% single-day market decline means for a country simultaneously fighting a war. Let me give you the numbers. Israel's defense budget for 2026 is approximately $24 billion, already doubled from pre-war levels. That budget is funded through tax revenues, government bonds, and emergency war financing. The bond market is critical. Israel has issued approximately $18 billion in war bonds since February 28th. War bonds are priced relative to the equity market. When the equity market falls 61% in a single session, the risk premium demanded by bond investors increases dramatically. Israel's 10-year government bond yield, which was at 6.2% before the market opened, reached 11.7% by the time trading was halted. At 11.7%, the interest cost of Israel's existing war debt increases by approximately $2.1 billion per year. Each new bond issuance required to finance ongoing military operations now costs twice what it cost 48 hours ago. The $6 billion in planned April and May bond issuances will now cost an additional $700 million per year in interest, every year, for the duration of the bonds. The war just got $700 million per year more expensive, from a trading session that lasted less than 3 hours. But that is only the direct cost. The indirect costs compound it. Israel's technology sector. The TA-35's largest component, representing companies like Checkpoint, CyberArk, and Tower Semiconductor, has lost 61% of its market value. When your stock falls 61% in a day, 3 things happen immediately. First, your ability to raise equity capital disappears. Second, banking covenants may be triggered. Many corporate loan agreements require additional collateral or immediate repayment if market capitalization falls below a certain level. Third, key employees compensated in stock options watch their compensation evaporate, creating immediate retention risk. The technology sector employs approximately 350,000 people in Israel and contributes 18% of GDP. Its collapse is not a market story. It is an economic story, and economic stories become political stories. Now let me tell you what the official response looks like, and why every tool available moves slower than the damage already done. The Israel Securities Authority halted trading at 12:47 p.m., 2 hours and 47 minutes after the opening bell. The halt stops new damage. It does not reverse the 61% that already occurred. Under Israeli securities law, a trading halt can last a maximum of 3 trading days, during which the fabricated intelligence documents are still circulating, the short positions are still in place, and every institutional investor who reduced exposure during the crash is deciding whether to re-enter a market that just demonstrated it can fall 61% in less than 3 hours. The United States SEC issued a coordination notice to securities regulators in 14 jurisdictions, requesting emergency disclosure of beneficial ownership data for accounts that held significant short positions in the 72 hours before the crash. 14 jurisdictions, each with its own legal process. The fastest, Cyprus, can respond in approximately 72 hours under emergency protocols. The slowest, Liechtenstein, has a standard timeline of 30 to 45 business days. By the time the full ownership picture emerges, the positions will have been closed, the profits moved through additional layers of financial entities, and the trail cold enough that attribution will be assessed with high confidence rather than certainty. The difference between knowing who did it and being able to prove it in a venue that matters. Here are the three options Washington and Jerusalem are now considering. All of them are inadequate. Option 1. Emergency financial support. The United States extends an emergency credit facility to Israel, providing dollar liquidity to stabilize the shekel and support government bond issuances at manageable yields. The problem: congressional authorization takes days minimum. Israel needs market stabilization in hours, and American financial support does not address the 61% equity decline that has already occurred or the covenant triggers already firing. Option 2. Regulatory counter-operation. Publicly and definitively debunk the fabricated intelligence documents to restore market confidence before trading resumes. The problem: debunking requires Israel to publicly disclose its actual Arrow missile inventory, classified information with operational security implications. The choice is between market confidence and operational security. Both matter. Both cannot be fully protected simultaneously. Option 3. Accept the damage, stabilize what can be stabilized, pursue financial attribution and legal action over months. The problem: months of legal process across 14 jurisdictions produces accountability eventually, but does not fund the war that needs to be funded now, does not restore technology sector valuations affecting 350,000 jobs, and does not prevent the same operation from being repeated because the structural vulnerability has not been fixed and cannot be fixed quickly. Here is what you need to understand as we close. Iran did not fire a missile today. It did not launch a drone. It did not cut a cable or release a pathogen or capture a drone. It opened a brokerage account 18 months ago in the British Virgin Islands, and then it opened 340 more across 14 jurisdictions, and it waited. Total capital deployed in the operation, estimated at $4.7 billion in short positions, plus operational costs of approximately $50 to $80 million for the network of shell companies, nominee directors, legal fees, and information operation infrastructure. Profit from the operation at 61% market decline, estimated at $2.8 to $3.1 billion on the short positions alone, before accounting for put option gains of another $800 million to $1.2 billion. Iran will net approximately $3.5 to $4.3 billion in profit from a trading session, while simultaneously inflicting $240 billion in market capitalization losses on its adversary and increasing that adversary's war financing costs by $700 million per year. This is not financial warfare as a concept. This is financial warfare as a completed operation with a profit and loss statement that reads better than most hedge funds. Share this video, because the financial press will show you the TA-35 chart and the circuit breaker halt and the government stabilization measures. It will not explain the 18-month position-building operation across 14 jurisdictions. It will not tell you that full attribution takes 30 to 45 business days in the slowest jurisdiction. It will not do the math on what 11.7% war bond yields mean for Israel's ability to finance the next 60 days of operations. They will give you the version where regulators respond and markets stabilize and perpetrators are identified. I just gave you the version where the profit was $3.5 to $4.3 billion, attribution takes months, the structural vulnerability is unfixed, and the war just got $700 million per year more expensive. $240 billion erased. 2 hours and 47 minutes. 18 months of preparation. 14 jurisdictions. 340 shell companies. And a weapon that left no blast radius, no satellite signature, no missile trajectory. Just a chart that went straight down and a bond market that will not forget what it saw today.